Kotecha, Head of FX and EM Macro Strategy Asia at Barclays. We're also joined in by Jahangir Aziz, Co-Head of Economic Research at JP Morgan. Great having both of you gentlemen this morning to kind of contextualize this. Jahangir, let me first start with you. This is a severe escalation of sorts. How big, how bad? Give us a perspective.
Look, it's very difficult to say how bad or how big it is going to be and how long it's going to last. The fact that you did see a spike in the oil market clearly shows you that the market is nervous with the last round. But that's not the story. You keep repeating, I mean, not you, but everyone keeps repeating the Brent prices. But the oil market has been fragmented completely. The Brent prices is essentially telling you the supply and demand in the Atlantic basin, where in reality, countries like China, India especially, depend upon the market in the Middle East, which is facing a severe supply shortages. So if you look at Oman and Dubai prices, even before this strike, Oman and Dubai prices was already trading at about 100, above 150. And more than that, if you just look at the India basket yesterday was at $145. So I think we need to stop looking at the Brent prices and taking solace or getting alarmed by the Brent prices. I think we need to look at Oman prices and Dubai prices because that's what really matters, at least for the Asian economies.
Jahangir, how do you look at what the Fed did last evening? Do you see going into 2026 that the rate cut cycle is almost over now, and maybe we could see one rate hike if inflation persists above the Fed benchmark of 2% or so?
So we didn't have a rate cut in 2026, at least since the big start of the year. So our view was that you wouldn't see any rate cuts in 2026. And in fact, the next rate move would be in 2027, which would be a rate hike. Now, this has nothing to do with the war. It had nothing to do with what's been happening over the last 8 days. Obviously, the last 2-3 weeks. Obviously, the last 2-3 weeks have added more concern over that. Our view was completely based on the dynamics of the U.S. labor market. Our view was that even if you get a very modest improvement, modest in terms of relative terms of, let's say, 50,000 job growth, non-farm job growth in 2026, given where immigration is, given how low immigration flows have been, wages will move up, and with that, unemployment rate will be falling, and that will prevent the Fed from cutting rates, given that this will keep rates, keep inflation very sticky above the 2% target of the Fed. So we really did not have any rate cuts in 2026. So in fact, the dot plots actually are much more dovish than our view. And our next move was a rate hike in 2027. Whether in 2026 we'll have a rate hike or not, there, I think Chairman Powell's statement today that given the history of inflation, in recent history of inflation, they would not look through the energy price hike, quote unquote, too lightly. I think that could be a telling that, this time around the Fed would be much more careful at looking through energy price hikes. So we do not have a rate hike in 2026, but we never had a rate cut in 2026 since the beginning of the year.
Mithul, let me come to you. It's one of those days where it seems that we're going to see plenty of pressure, at least on Indian markets. And some of the happenings over the last 12 hours have obviously surprised global markets as well. How surprised are you? Give us a sense of that. And how are you allocating? Give us a perspective on what exactly should one do at a point like this?
Look, I think it's very difficult. I mean, to Jahangir's comments, I think, look, we still, and clients and investors are looking at the duration, the breadth of this conflict. And again, look, these reports of energy infrastructure being hit clearly add another dimension to this war, and obviously will pressure and have pressured oil prices higher. And look, so I think there is still this, and as we've seen from the sell-off in US equity markets and pressure in Asia this morning during this session so far, clearly risk aversion is again intensifying. So I think investors are still looking for safe haven assets. In that sense, what's been interesting to us is, for example, a dollar has found its feet again. Not long before the war, we were all in a sell or hedge America tone, and suddenly the dollar's gained some of its momentum as a safe haven. Perhaps not as much as you would have expected, but it has rallied. And I think investors are still steering clear to some extent of risky assets until there is some clarity. And every time we see a little bit of a bounce, as we saw, for example, in the early part of this week, pressure is renewed and we see more reports and more news. And it's such a volatile, fluid environment that we're in that it's very difficult to see beyond the length of your arm in this environment. It's tough, and I think investors are seeing that. So risk has been taken off the table. I think very much positioning is becoming very tactical. Safe havens are still very much in demand at this point in time. Risky assets are under pressure, and everyone is watching the duration of oil, not just from a shock in terms of inflation risk, but in terms of the stagflation angle and how much ultimately will there be a demand shock coming from higher oil and higher energy prices more broadly. And also, it's not just about oil and natural gas. What about fertilizers? What about helium? What about all these other commodities that have to go through the Straits of Hormuz? So I still think there's so many unanswered questions to have a very clear and long-term view on assets at this point in time.
Mitul, the other big risk is on the FX side of things, right? Asia in particular has a large dependence on energy infrastructure in the Middle East as well as in other geographies. Give us a sense of what this does to EM markets from a foreign exchange perspective. You've already seen a bit of a spike on the dollar. What does this do, and what should one brace for?
Well, I think what we have started to see is some move out of carry trades back into safe haven assets in terms of EMFX. As I mentioned, the dollar has generally been firmer. Our analysis of oil price shocks show that it hurts CEE currencies quite significantly. It means, for example, that carry comes off in some areas. But Brazilian real is a good example. It's a net oil exporter, but it's a high carry currency. It's buffeted between these two forces. But overall has done reasonably okay because of its oil exporting stance. Whereas Asia, as you mentioned, the region is a net oil importing region. Many currencies have been hit since the war began. The likes of, well, let's say Indian rupee, of course, has been one big casualty, but Korean won has been hit, Philippine peso, Thai baht. Now, Asian currencies are expected to continue to be on the back foot as long as this conflict goes on. Today, we've already seen more extensive pressure across Asian markets. And unfortunately for the rupee as well, it leaves it continually exposed to this energy price shock that's continuing to inflict damage. And with oil pressured higher, and again, not just Brent, but as previous speaker mentioned, oil in Qatar, Oman, etc., and how much we're paying in Asia for all imported oil, that damage is getting worse by the day.
Jahangir, how do you read the benchmark 10-year yield, US 10-year yield now? Because it's hitting 4.26. It seems that it's not only factoring in the inflation that's expected, but also maybe the rate action during the year.
Right. So I think what the market did was essentially take the Fed call in a hawkish tone, because remember, unlike us, the market did actually have rate cuts built in for 2026, but the market did the right thing, which is basically flattened it out. I think it's the flattening rather than the move up in the 4.2 in the 10-year rate. That's a bigger story, and I think chances are that as these inflation pressures pick up and whatever lingering hopes the market has of rate cuts in 2026 fade. As I said, we don't have any rate cuts at all. Fade. I think you are going to see much more a flattening of the rate cut rather than a spike in the 10-year rate. And in line with what Mitul said, which is that, look, we haven't seen the demand destruction as yet. if this inflation actually becomes sticky and starts moving into core inflation, I think you are going to start seeing demand destruction. Or even if you don't start seeing demand destruction, people will start pricing in demand destruction. And in demand destruction environment, it is hard to see, the 10-year actually blow up. What you will likely continue to see is that the short end of the curve not being able to support the low growth simply because inflation stands in its way.
Okay, Mitul, Jahangir, thank you so much for coming in and speaking with us. It's been extremely meaningful, this conversation, to set the context up, because it's really clearly going to be a very difficult day of trade, because it's not just global, it's also domestic. And in terms of the FIDI data, let's